In the last few weeks, several relevant economic data have been published. These are explained below, as well as our forecasts. We tell you the truth exclusively in a few seconds. Tod-Ai, Market News. The characters are fictitious and do not correspond to real people. Invest at your own discretion. Script and production by Edgar Garcia de Pereda. The first important data is the balance between oil production and consumption. Within an economic growth, higher oil demand is expected, which could mean that there is not enough of this raw material available. The balance is now positive, but not risk-free considering that it is very difficult to exceed 105 million barrels per day. Demand could overtake supply between 2025 and 2026. This is why many central banks have decided to raise interest rates, in order to halt economic growth. Brazil, yellow line, started in 2021, United States and Europe in 2022. Only China, orange line, has relaxed interest rates in the last 2 years. Central banks globally have kept liquidity high since October 2022, despite the fact that rates have continued to be raised. This is intended to keep the economy and markets afloat. Overall liquidity is 30% higher than in February 2020. Markets have reacted to the liquidity injections with delight, is now also about 30% above the pre-pandemic value, mainly driven by technological stocks. Governments have also taken advantage of more liquidity to increase their debt. The graph shows the examples of the United States and Brazil, which have increased their debt by nearly 50% in 5 years. All this liquidity injection has kept employment data in good numbers, even somewhat better than those of 2019. In the United States and Europe, we are beginning to see a deterioration, but still to be confirmed in the next months. But this joy has also generated inflation. More money has meant higher costs and everything has become significantly more expensive. For example, inflation in the United States has risen almost 23% in just 5 years. In the last month it has fallen, raising hopes of a moderation or even a change in trend. But the consumer has been impacted. What you pay for interest, blue line, has risen by more than 60%. Credit card defaults reach almost 9%, its expenses have risen 4% more than its income, and savings are 34% lower than 5 years ago, despite having risen sharply during the pandemic. Consumers are being exploited and their numbers are getting worse, and is additionally ultimately responsible for the large public debt. If the consumer cannot sustain the economy, it does not look like the government will be able to do so either. The enormous increase in expenses it has to face for debt interest payments leaves very little room for maneuvering to stimulate the economy. The government needs more liquidity and inflation to better deal with debt. Companies have reported good results, but warn that the future may be worse. From the end of 2022, retail sales are growing below inflation. This may accentuate the rise in unemployment and the onset of a recession. The following, we see different opinions that analyze the situation in more depth with exclusive analysis.
Interest rates have outperformed those of 10-year bonds. This is not normal and raises the risks of recession and deflation. The story here is long. The state has a worse valuation of its debt now and has to raise interest rates to make the buyer feel attracted to purchase such debt with higher risk. This caused the investor to withdraw the money saved from the banks and put them in the debt that offered the best returns. This has forced the Federal Reserve to raise rates above those on the 10-year bond for banks to maintain liquidity. The Fed cannot lower rates, which reduces borrowing and, therefore, economic activity. These contexts are more for saving and reducing debt as much as possible.
The fact that the banks now need liquidity is obvious. This is precisely why they are reducing the amount of money leveraged daily in the repo market. Bank revenues may rise with higher interest rates, but so do defaults, and they need to hedge against potential risks.
The problem is that U.S. bond yields cannot fall much until the U.S. improves its debt rating. The Federal Reserve has to keep rates high and liquidity high as well, rather unusual. In principle, we will see that the market will buy U.S. debt and the dollar will be strong against other currencies, but not in relation to commodities or digital assets. Markets will fall due to inflation damage and consumption, but liquidity will be able to sustain and even recover them. The big crisis will come when the government will have to reduce debt and spending at a time when, in addition, oil will not be enough, we believe by the end of 2025 or 2026.
It won't help if China stops growing as it has been doing. Neither India. These countries are also victims of raw material shortages. Money can be printed, but not raw materials. Other growth models must be sought, but at the moment they are not being implemented.
Our outlook for a major crisis in 2026 remains unchanged, with more reasons than ever. Don't forget to subscribe and leave your opinion in the comments below.